been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is CEO and Managing Director of Indus Communities, Ajay and Manu Gupta. Indus was founded on a simple yet powerful idea to transform neighborhoods and lives. Since 2002, their team has been committed to making neighborhoods stronger and safer by revitalizing communities in the greater Houston area. Now, as a family-owned business, they have made a conscious choice to pay for their success forward by helping their residents who live in their properties along the way with their family and friends. Now, this philosophy also extends to their employees who proudly own 25% of their business, and that's something that hopefully we'll be touching on today as well. And so, guys, I'm excited to introduce Ajay and Manu to the show, but before we dive into it, just have a few quick housekeeping items to run through. First and foremost, as I've mentioned here over the last couple of weeks, our third mobile home park investment fund just went live a couple of weeks ago, and have had a lot of interest. A lot of pent-up demand, I think, because we have not had an offering come out now for nearly 2 years, and so it's been quite a number of months, and so lots of pent-up demand to get into the mobile home park space, and so it's just excited to be able to announce that to you guys. And just for some additional context, this is a Regulation D 506C offering, and it's open to all accredited investors. And for those that don't know, if this is the first time you're listening to the show, you don't know about me and my background, my team and I, we've been investing in mobile home parks, specialized in this space for nearly a decade now. Way back before, most investors even would consider this amazing investment vehicle. And now, the secret's kind of out. I wish I would have bought them all up 5 or 10 years ago, but now the secret's out, and all the big groups such as Carlyle Group, Blackstone, Apollo Group, and many other PE firms are in the space. And again, it's no longer a secret. So if you guys want to learn more about, partnering with a team that has a phenomenal track record, you can go over to our website, investwithsunrise.com. Again, that's investwithsunrise.com. And there you can watch our most recent webinar and also access our PPM and offering docs. And, we kind of specialize and we really emphasize our ability to find off-market deals. It's something that we've honed in on over the last decade that we've been doing this. So we do a lot of direct-to-owner marketing efforts. We've got a proprietary database we built out over the years. And so on average, we make about 500 cold calls a week. We've got a team that does that on our behalf, and also sending a lot of direct mail and other sources of direct-to-owner marketing. And so we simply don't rely on on-market deals. We go direct to owners, and have bought about 80% of our portfolio that way. So again, go to Invest with Sunrise to learn more about that opportunity. And moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please take a moment to subscribe to the show. That way you'll get notified when all new episodes come out. And also, if you haven't done so, leave a rating and review. It really helps us attract awesome guests such as who we have here with us today. So take a moment, leave that rating and review, be honest with it. And again, we're here to help you guys. We're here to help you grow your business. So hopefully you love what we're doing here. And lastly, before we get on to it, I want to remind you of the free 30-minute phone call that I offer each and every Friday. This is where I set aside 2 to 3 time slots of my time every Friday. I've been doing it now for 6+ years, to where you can connect with me. We can connect and talk about real estate investing, basically anything your heart desires about the real estate investing space, whether you're brand new or a seasoned pro. I just love sharing, the passion for real estate investing with others that I come in contact with. And so if that's you, then I'd love to talk with you and connect with you. So go to my website, kevinbupp.com, to schedule that free call. And I promise I won't try to pitch anything. This is not like there's no ulterior motive here. This is a way for me to connect with our listeners. So in any event, kevinbupp.com to schedule that call. Now, guys, without further ado, I'd like to welcome our guests for today's show, Ajay and Manu. Guys, how you doing today?
Great.
Yeah, doing pretty good. Thank you for having us, Kevin.
Yeah, thanks for joining me here. Excited to be chatting with you guys. You guys have quite the extensive background as far as how long you've been in the multifamily space. You've gone through one downturn already. You guys, it looks like you established in 2002, so you had a couple years before things took a dive for the worse, and you guys have obviously come back out of it, and you've been growing since then. And now we find ourselves again in some very, I'm gonna call them unique times. So I'm excited to dive in that, but we'll wait to get into that conversation here in a few minutes. But maybe first and foremost, if we could, for those folks that aren't familiar with you and your team and what Indus Communities does, maybe tell us a little bit more about yourself individually, and then a little bit more about Indus Communities.
Yeah, Dad, go ahead. You can start and I'll jump in.
We started the Indus, our group in 2002. And I was before that in an electronic business for 15 years and was looking for diversify in some other industry. Mm-hmm. I bought a first apartment complex in 2002. And then after that, we keep buying on and on. And now we have 30 properties with 8,000 units.
Wow. Okay. Fantastic.
Yeah.
Manu, how about yourself, buddy?
I probably joined, 2012 now? It's 8 years. I feel old. So I came out of actually medical school. I went to medical school and got my MD. And when I moved back to Houston, I started working at MD Anderson, doing some academic work, and was helping Dad on the side. And, I started enjoying it. I like being able to put down some roots and have that tangible feel of getting my hands around something. So I made a little career shift for a year, and that year turned into a few, and here I am now. We started at 6 apartment complexes when I joined. Now we're at 30. I think just being with Dad and having that extra energy let us grow and multiply. And it's all on our team. We have good people surrounding us, and at the end of the day, Houston's been good to us. So we've been trying to give back ever since.
Okay, fantastic. AJ, how long was it until you were able to kind of exit out of your electronics career and move full-time into multifamily investing?
We sold our business in the late, basically in the 90s, maybe in 99 or 2000. So it took about 18 months to find what I'm looking for. And then I started the business in 2002. By that time, the electronic was already sold, but the business was gone. So
okay, got it. And
I didn't know anything about the apartment industry, so I learned everything from scratch.
And got it. So lots of mistakes.
Yes.
Did you self-manage that first property?
Yes.
Okay. And then
we walked in and we had the key in the night drop. We didn't know how to run the business, but we figured out.
Fantastic. And is Indus Communities vertically integrated today in the property management side, or do you outsource to a third-party firm?
No, we are self-managed.
Okay. Has it been that way the entirety of the time?
Yes.
Okay, fantastic. It seems like you're the I'm not going to say the anomaly because there's obviously others out there that vertically integrate, but I'd say that the majority of folks that I've talked to that have portfolios similar to your size, a lot of them are outsourcing to these third-party management groups. What is just from a higher level perspective, what are some of the reasons that you have chosen to go that route versus handing it off to a larger management company?
We want to provide a better customer service to our communities, and they have a one-on-one connection with our office, and we can take care of better than the management company because they just work for the money, mm-hmm. and they don't take care of the tenants as well as we can.
Yeah, I always like to say, there's no one's ever going to take care of your property as well as you. I don't care who they are or what their track record is, but no one's ever going to care for your property as much as you do. It's just never will be the case ever in my life, I don't believe. So, the obvious reason of why Houston is because you guys live there, right? But had you considered at any point in time during, these growth stages of Indus, had you guys ever looked outside of Houston and considered other markets? If so, why, or if not, why?
I can kind of jump in and answer that one. Austin and Dallas, those are the ones on everyone's radar, San Antonio as well. I think for people and investors, those are probably better cities because they can fly in. If you're an outside investor, it's easier to get to Dallas. It's easier to get to Austin than it is to Houston, even though it's only another hour or so away. But for us, Houston's home. And like Dad was saying, we like that hands-on approach. So we're able to drive to any of our properties within half an hour right now. And our corporate office is also maybe 20 minutes from any property, centralized. Mm-hmm. So that gives us that advantage of just being hands-on, being there for our assets and being there for our residents.
Got it. And what is the general grade of asset that you guys have in your portfolio? Are we talking, B-class assets, C-class assets, a mixture of the two?
C class and B class. So usually we'll buy a C, C minus, maybe a D plus, and we'll upgrade it. We'll put a significant amount of money into our assets, and they get upgraded, whether it's location, just the tenant base. What we bring to it, we feel like it gets upgraded, and we've been able to get it up to a B.
Got it. Houston, again, we're in unique times today. The entire world is with regards to this pandemic, but, Houston itself, its economy is tied a great deal to the oil and gas industry. And obviously that industry has been impacted as well. What are you seeing from like boots on the ground floor? I mean, we can read as many reports as we want. We can watch the news, which half the time is just really an opinion, not really stated facts. But what are you guys seeing there, boots on the ground, as far as a direct impact from both of those things? Again, the pandemic and the, I guess the downtick in the oil and gas industry.
I mean, I would love to tell people that it's terrible here so they stay away, but Houston's so diversified now. I mean, we're not just an oil and gas city. Yeah, that's a big chunk of it, but we're healthcare, we're aeronautics, we're a ship channel and supply chain management and warehousing. There's a huge diversity now here. So I don't think oil and gas really hurt us that much. I mean, it definitely put a little damper on the upswing, but it's been coronavirus that's really hurt us. But we fared well. I think, when March rolled around or late April, I called an emergency meeting because my medical background, and I knew something was happening. I knew, things were looking bad. So I sat down with everyone before probably maybe a solid month before they started shutting things down. I said, hey guys, we need to have a plan just in case this gets worse. And that really helped us. But we expected 20 to 30% drop in income. We were afraid people would be out of the jobs, people on the streets, just revenue would die. Right now, we're probably, about 1.5% down from where we were on an average basis. We've weathered this really well. One thing we've done is we've raised about $1 million for our residents for direct rent relief through city programs, through third-party charities, things like that. We've worked really hard to focus on our residents and our team members.
Yeah, that's fantastic. And, it's interesting because looking back, middle of March, rolling into April, I think anyone that had rental real estate just assumed the worst, right? You plan for the worst, hope for the best. We did the same thing. And I don't know if we had assumed that we might see like a 20 or 30% loss of income or delinquency rate, but we just didn't know. And so again, we planned for the worst, and ultimately, April came and April went, and everyone in your industry and our industry, and again, so long as you didn't own hospitality and retail, right? But in the residential real estate rental industry, everyone fared very well. And then May came, they fared very well. Stimulus kicked in, and I was of the opinion that after that initial stimulus ran out, being that they still haven't been able to get their act together to get a second relief package out, I was of the opinion that we would ultimately see the biggest downtick, when that, I think it was July, I forget the date in July, but whenever it ran out. I was assuming that come August or September, that's when we would see, the biggest downtick, if it was going to happen at all. But we still haven't seen it yet. And so I'm somewhat a little shell shocked. I'm a little surprised, because at the end of the day, the unemployment rate across the country is up. I'm not sure exactly what it looks like in Houston, but just generally speaking, unemployment rate is up, and no additional stimulus that is being given out to the people, the folks that are out of work. And the regular unemployment benefits typically aren't sufficient enough to maintain a family on, as well as the roof over your head and what have you. And so have you guys noticed any additional downtick after that initial stimulus ran out?
We talked to, I'm going to jump in real quick and then I'll let Dad speak. I feel like I'm dominating here a little bit, but we were talking to one of our financial institutions, and they were saying that they've noticed that the bank balances for their customer base has been decreasing over the last month or two. So if there's no stimulus in the horizon, they're going to see people having to make tough decisions.
So people are living on their savings right now is
right.
What
they're
that
living
means.
on the stimulus. They're living on any savings they have.
Yeah.
And, they expected that to happen sooner, it hadn't happened, but they're noticing it now. And toss it over to Dad and get his thoughts.
Yeah, I think so. In our last 1 month, last 30 days, our delinquency also went up. Instead of a 1.5%, it's 2.5%. So people are basically pretty much end of their savings what they have. And I think so in the next few months, if the package doesn't come, will be a difficult time for them to pay the rent.
Yeah. And, I guess the flip side of that question is, has the demand for your units, available units, has that changed? And so are you seeing, so obviously there's a delinquency issue happening. It could get worse. I'm of the mind that I think inevitably, again, I'm not a doomsdayer at all. I just think that there will be fallout. Whoever ends up in office, or either gets reelected or ends up in office, there will be fallout from this. And, kicking the can with the stimulus packages, I think that's all we're doing. But ultimately, there will be longer term fallout. What's your guys' crystal ball showing you as far as what the next 6 months or a year looks like? Are you kind of still planning for not a worst case scenario, but worse than what it looks like today?
I think so. In the next 6 to 12 months, most likely the industry will be flat or maybe 1% down, 1 to 2% in a collection and occupancy.
And how about the demand for your available units? The surprising thing that we saw on our side was we actually pretty much shut down all of our sales and leasing. We do both. We do both sales and leasing. And from basically the end of March, and then we kicked it back in gear late April. So about 3 to 3.5 weeks. But the one thing that we didn't do, we never took our ads down. We simply just basically, shut down the leasing offices. Our managers weren't showing units or anything like that. But I never noticed much of a downtick in the actual demand or the inquiries that were coming in from our posted ads on our available units, which was very surprising to me. And once we ramped things back up, we had actually a record 30 days, fourth week of April leading through, the third, fourth week of May. We had a record sales month, which was baffling to me. How has that looked on your end?
Yeah, I think since I guess March, we're down probably only 0.5% in occupancy at most. What we've noticed is, we're considered an essential business. So we've been open since March. What we did was lock the doors in our leasing offices and say, hey, appointment only. One person at a time was allowed in. We followed the PPE and social distancing guidelines along those lines. So, and we told our, team members that, hey, if someone's coming to the door to rent something, they really want to rent something. No one's out here just for fun, window shopping, anything along those lines. Because at the end of the day, Houston is such a huge city, and we have such an influx of an immigrant population that people need a place to live at the end of the day, and we want to provide, the best that we can to these people. So we haven't seen much of a tick down since the beginning, but on the horizon, if we don't get any kind of stimulus or there isn't a plan for combating the coronavirus, I think, it might go down a little bit, or at best, we're hoping, it stays flat.
Have you, has your team purchased any new properties here, from March until present day?
Yeah, we're closing actually on a 400 unit property, 396 exactly, but on November 10th. Okay. So we have one coming up. It's just a great opportunity. We actually looked at this property in March and had it under LOI, but not because of coronavirus, but because of the property taxes here. Their property taxes tripled actually this year. So we had to, the underwriters couldn't underwrite it anymore. So we had to drop it, and things got mitigated and things got better. So we got the deal, and we're taking over on the 10th. We actually sold a deal also on Friday. So there is some action out there, but we think in the next 6 months it'll improve and there'll be more transaction flow.
How has your business changed on the acquisition side? I mean, have you instilled, stricter underwriting guidelines? And if so, maybe offer some specifics on what that looks like, those changes look like.
So I do the acquisitions. Luckily, he lets me. So I do the underwriting, and our upside's not there. We don't expect, jumping 10 to 20% on rents in 2 years as we normally see it. We'll underwrite it maybe a 5%, 10% growth at most over 2 to 3 years now. So we're a lot more conservative on the underwriting. aspect. Expenses are definitely higher, and we underwrite the occupancy to be just a little lower than we would have thought it would be. We've been growing as a company 15 to 20% on an annual basis. This year will only be about a 5% growth. So for us, that's definitely a contraction, but we're blessed. We're lucky that we're able to grow. And we've taken care of every one of our team members, no layoffs, no furloughs. We did take advantage of the PPP, as many companies did, because number one thing is we wanted to make sure that people had jobs, and we were actually hiring through the downturn so that we could get people, those jobs that they needed.
Yeah, that's fantastic. Can I make the assumption that the property you'll be closing on in November, is that an agency loan that you're going to be receiving?
It is a bank loan.
It's a bank loan. Okay, got it. Have you noticed? Well, good. That even helps with this question a little bit more. I know that Fannie and Freddie obviously had put in some reserve guidelines, like everyone kind of just, okay, let's wait and see what's going to happen. And they instituted some pretty aggressive reserve guidelines, and they've since lightened up on those over the last couple of months. But have you noticed with as you went shopping for financing for this particular deal, was there any additional bearish behavior that you received from the banks or lenders that you proposed this deal to?
I think so. The lenders, the Fannie Mae and Freddie Mac, they lowered the loan value instead of giving 75%. Now it's 65 to 70%. Plus, they're asking the reserve for 6 to 9 months for the PI. And they are not giving any rehab budgets. So the spread is a little bit more higher than before. So it's not attractive anymore. You need to bring at least about 45% to close the deal, which is not workable with the numbers. So bank is more attractive.
And how does that differ? If you don't mind sharing some details on how that differs to what type of terms you're receiving from, you don't have to give the name of the bank, but just generally speaking, what had you go? What encouraged you to go that route versus Fannie or Freddie?
A bank was willing to give us 75% to us for the LTV, and plus the interest rate was about 60 basis points lower than the Fannie Mae and Freddie Mac.
Wow.
And also that is a bridge loan for 2-3 years. So after 3 years, you can do the refi and go to a permanent market data for 10 or 12 years.
Got it.
Sorry to interrupt. They were also giving the rehab budget. So they were funding that 100%.
Wow. Okay. Is that a local bank that you've dealt with before? Or?
Yes.
Okay. Fantastic. I read an article, not to switch gears, but I read an article before we jumped on here. I was just trying to do some research on just really the direct impact on the Houston market. I know that you guys aren't in the hotel space, but I was shocked to see that Houston hotels, at least 72% of the hotels that have securitized debt, CMBS loans in place, are delinquent, whereas like the national average is like 23 to 24% of CMBS loans attached to hotels are delinquent. What are your thoughts there? I mean, again, I know you guys aren't in the hotel space, but what are your thoughts on what the future of the commercial real estate looks like? And more specifically, retail and office and again, lodging took the biggest punch in the face, and it's still, it's going to drag out for quite some time, and a lot of them just won't make it. And but what's your perspective or opinion on how the commercial market's going to fare through this in Houston?
I think oil and gas that's where it kind of came in. These companies started trimming their travel budgets, and that hurts the hospitality space. If people aren't moving, they're not coming down here because of oil and gas or meetings. And then we learned new skills. We learned Zoom. We learned WebEx or Skype, whatever you may use. We learned how to use video chat, and we've learned that that's a lot cheaper than getting on a plane and talking to someone, and almost just as good. So I think that's what's made a change in the hospitality market is people don't have to travel, and of course the fear of traveling altogether. Houston is a big port for cruise lines and things along that line. And of course that shut down. So I'm sure that hurt as well. On the commercial space, I mean, I wouldn't want to be in an office building, owner right now. I think companies are realizing you can work from home. You don't need that much space per person as you needed beforehand. And that might be the new normal. So it's going to be harder to fill up those spaces. But going forward, it's gonna take a while to rebound, and people are gonna have to get creative to draw people to their buildings.
Mm-hmm. It takes me to my next question. Assuming that there's going to be, some blood in the streets, again, in those other sectors, hospitality, retail, office, have you guys considered any additional niches outside of multifamily, given the fact that there might be opportunity coming that way?
We've looked to diversify actually in multifamily more than the other niche markets. Storage was always interesting, but that's, dominated by the big guys. Maybe we'll talk to you about mobile home park investing and figure something about that line.
We don't need anyone else in our space either.
We'll stay down here. So
right.
No, we haven't actually explored those other areas. Maybe going to other asset classes in the multifamily space, tackling the luxury market, more the A plus market. But no, we know what we know, and we're pretty good at it. And if we're spending X amount of energy somewhere, we're going to spend it in our market right now versus diversifying, because Houston has so much to offer still that we only own, I think, 1% of the C-class market or something now. So, there's still room to grow.
Yeah, fantastic. So, one of the things as I perused your website was that, you guys have correct me if I'm wrong, I mean, it's a profit sharing or an equitable vesting plan for your employees to where your employees own 25% of the company. I think that's pretty awesome and cool. Would you guys mind expanding, maybe giving some additional insight as to just, what pushed you in that direction and ultimately, what that looks like for your employees?
This is all Dad, so it's based on his benevolence and able. Yeah. He's using his own pocketbook to help our employees out. So, Dad, if you want to talk about that.
So, what happened to hold the good employees for a long time? You need to have some carrot, and they need to want some profit sharing. Mm-hmm. And in this industry, it's very difficult to find the good people. Mm-hmm. So, what we did, like just for example, we buy a property. And our key people, we give a 2% share, 3%, 5%, give a 100% loan, 50% loan, interest-free, and they can pay off in our next year, 2 year, 3 years time. So they have ownership. And we started with a few people and we keep adding up. Now I think so we have about 40 different employees. They're invested in the different properties. Like we buy any new, like this deal we are buying right now, next month, which we are closing, 396 units. We have about more than 50% in-house, basically, and only the 50% we are offering outside people.
Got it. That's fantastic. I think it's all about not just attracting, as you mentioned, the right talent, but actually retaining them, and giving them that incentive to stick around for the long term. Making it worth their while, because at the end of the day, there's always going to be other opportunities out there, other growth opportunities for people that want to move up in their career. But if you make those opportunities available in house, but then add an additional carrot, as you put it. You more so incentivize them to stay versus, spending the energy and going out and finding another position, but also like you're helping their family, right? In the long term, you're helping them and their family create their own internal wealth, right? Like invest right and create their own wealth that will provide for them and their kids and their grandkids and what have you. So I think it's a beautiful thing. So that's obviously one of the big components that sets Indus apart from hundreds of other, community operators, and maybe not as large as your group, but there's hundreds of other operators in this space, whether it be Houston or the other markets in Dallas or just across the country. But so that's a big part that I think sets you guys aside from, all the rest of the industry. But what are some of the other aspects that you feel really set you on a pedestal above some of the other apartment operators out there in the world?
Like our CFO, he joined us about 6 years before, and he invested in one property, and today he's in more than 10 properties as an investor. My CEO, he's invested in about 15 to 16 properties. So all these key people, they're going to retire with this Indus. Yeah. And they just believe they own the company now. Mm-hmm. So they control the expenses, they watch the venues. So instead of only 2 sets of eyes, now there is 20, 30, 40 people are watching. What is the wastage is there, how we can improve the system, how we can increase the income, how we can increase the bottom line. That helps a lot to us.
Yeah, no, that's fantastic. And what is the long-term plan for Indus Communities? With most of your assets that you purchase, is it to buy and hold long-term, or do you typically have an in and out plan of 3, 5, 7, 10 years?
Just for example, we bought one property about 3 years before, and that property was 100% for our employees, including us. We did the investment about $1 million, the rest of the bank loan, and we just sold that property last week. And we got all the investors got a $1.8 million. So they got the preferred returns plus the $800,000, about 90% on their investment in 3 years' time.
Got it. So is that the plan for most of the acquisitions? Is it a 3 to 5 year plan, or do you intend to hold some of your assets, for decades?
The majority of our assets we've held for a long time. I think every year or so we buy one asset that we'll hold for 2-3 years, and we'll sell it and help the employee base and help our team members that way. But we've had stuff he's had for 15-18 years now, and usually it's long-term cash flowing properties. At the end of the day, it's mailbox money, and that's what we're working for. It's not that quick fix.
Yeah, no, that's fantastic. Well, guys, this has been a lot of fun. You guys have shared a lot of great information here today, lots of golden nuggets. But what I'd like to ask of you, and it could be either one of you, answer or both of you, it's completely up to you. If you had one final golden nugget of advice or wisdom that you can leave with our listeners here today that might inspire and motivate them as they progress in their own real estate investing career, what would that one last golden nugget be? On my side is, don't stretch yourself too thin. Invest only what you can invest. Don't mortgage the house. Don't, take out a second loan or anything. Sometimes, you see that investment and it looks great, but, you have to be careful, because at the end of the day, you got to make sure that you're comfortable and you're safe and your financial planning. Mm-hmm. No, great advice.
And also in real estate, I think so if somebody wants to make a quick money, that is not the right business. It's a long haul business, 10-20 years, then you make money. It's not overnight you become rich.
I agree. You might hit a home run here or there where it happens, very quickly. But I agree with you. It's definitely a long haul business and one that takes time to grow. What probably the three of us define as true wealth. And I think that I think that is a big mistake. A lot of folks get in and they think that it very much is a short term business. I mean, gosh, just to get a firm grasp and understanding of the business takes years. To really master the business takes years. If we went back and looked at that first property that you purchased, AJ, again, you didn't have any experience in multifamily landlording. You learned a lot along the way. And I'm guessing for those first couple of properties, you were continually learning new things and learning how to improve and get better, correct?
Oh, we're still learning today.
Yeah, that's it. Exactly.
We're still learning today. It's never enough. Exactly.
Well, guys, this has been absolutely fantastic. Thank you so much for joining us here today. And for those that want to learn more about you and your company, where's the best place to reach you?
IndusMGMT.com, IndusManagement.com. That's the best way. And, feel free to shoot us a message on there and we'll definitely get back to you.
All righty. Well, thank you guys for joining us. It's been a lot of fun.
Yeah. Thank you so much for having us.
Thank you.
All righty, guys. So that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.